Last time we were talking about short-term managerial decision making, and we just want to pursue that idea a little bit more today, just to, in a summarized way, to make sure that what we're talking about here is the determination of relevant costs. In other words, we have to, when we do make short-term decisions as managers, we have to focus on which costs are relevant. In other words, what makes a difference to the decision being taken. We'll be focusing on cash, clearly, and also on the future flow of cash over which we have influence. Sunk costs are not relevant. So if we have to isolate what the differences are in the before and after situation if we were to take a decision or not. Here's an example in the transportation industry, or with regard to insurance costs, in what way changing insurance costs would influence the decision that a company takes as to what form of transport to choose. Relevant costs are future-oriented. This is the essence of managerial decision-making. We're not describing the past. We're using data from the past that we use in order to anticipate how things could change in the future. Costing projects, for example, requires the use of relevant costs in order to do them properly. We have to remember to take into account as well opportunity costs. That concept is also extremely important in the relevant cost determination. For example, if a company gives up a parking lot in order to convert the space into a storage facility, for example, they would have to, if they were generating fees on the parking lot, they would have to take those fees into account in order to determine whether or not the storage facility is of benefit to the company or not. If the parking lot is generating $50,000 in fees at present, and the company is deciding to create a storage facility, they would have to take into their calculations the loss of the $50,000, and therefore the benefits of the storage facility would have to exceed the loss of the $50,000. Otherwise, they've made a poor decision to divert the parking lot to an alternative use. So it's things that are lost or foregone that becomes the opportunity cost. Now let's move on to something which is longer term in nature, and that is the area of capital investments and long-term investment decisions. Now there are certain specific techniques that apply to evaluating long-term investment decisions at a company. There are traditional measures which are commonly used by management. The accounting rate of return, for example, is one. Here's an example: 5-year project with an initial investment of $40,000. The accounting rate of return is an accounting profit-based measure, and what it does is it calculates the profits after depreciation for a project. You can see here, if we have profits before depreciation of these numbers here, we need to subtract each year 20% depreciation. This is on a straight line basis. Over 5 years, a $40,000 project is going to cause depreciation to be charged at the rate of $8,000 per annum. If we subtract 8,000 from each of the profit figures here before depreciation, then we will get the post-depreciation profit. And these numbers added together give us an average profit per annum profit of $6,600. So the accounting rate of return, if it's based on average investment amount, will calculate an average rate of return, an accounting rate of return of $6,600 divided by 20,000, or 33%. How do we get to 20,000? How do we explain the average investment of 20,000? Well, it's because we are depreciating the 40,000 investment. At year 0, we have 40,000 invested, but at the end of 5 years, we are effectively writing down that investment to 0, and therefore, over the period of the project, our average investment is going to be 40,000 divided by 2. If we, some companies don't calculate the average investment, they take the total investment in the denominator, and then of course the accounting rate of return as defined by total investment would be half of the first calculation, 16.5%. And yet there are some other companies that may choose to define the accounting rate of return differently. Again, they take simply the sum of all of the profits that are made over the life of the project, in this case $33,000, and they divide it by 40,000, which is the initial investment, and arrive at a 82.5%. Now, the interpretations and the meaningfulness of these ratios, these percentages, is at best questionable, and perhaps the only thing that can be said in their defense is that they are relatively straightforward to calculate. They derive from accounting measures, so they're easy to do, and of course one can look at several projects as long as one is using these measures consistently over time. One can see whether the trend of accounting-based rates of return are improving or improving, but even then we have to be careful. They are misleading indicators, and the reason will be clear to us as we move into other ways of being able to measure investments. Let's just have one more look at the accounting rate of return in cases where we have a $5,000 residual value. What do we mean by this? We mean that after 5 years, when the project is wound up, that means terminated, the equipment that was invested in can be sold for a scrap value of $5,000. Now, how does this affect our accounting rates of return? We're using the same numbers as above, but now we just need to, the only new feature here is that we have a scrap value of 5,000. Can the candidate see, think about this, why is the average investment now $22,500 instead of $20,000? And the answer is, well, if we invest initially $40,000 in the project, and at the end of the 5 years the asset is worth $5,000, then we could say that our average investment, in fact, is going to be $40,000 plus 5,000 divided by 2. We're just applying the same logic as we did earlier when we calculated the average investment initially without a residual value. And in this case, we can see that 45,000 divided by 2 is 22,500. Okay, now if we just recalculate the accounting rate of return figures here. Total profits before depreciation 73,000. Total depreciation is 35,000. Now where does this number come from? Well, if we are depreciating our asset from 40,000 to 5,000, which is the residual value, then the total depreciation over time is going to accumulate to 35,000, i.e. $7,000 per annum instead of 8,000 previously, which also changes therefore our total profit figure. One can recalculate these numbers to verify. We can see that therefore the average profit, instead of being $6,600, now becomes $7,600 per annum, and therefore the accounting rates of return are as computed here. Okay, I leave it to the candidate to summarize what they consider to be the pros and cons of using this kind of accounting-based measurement for determining the returns on an investment.